Let's go through our program today. First, how does it look now? The Dow Jones and the S&P obviously made a new high, Dow Jones above 38,000. But let's have a look at the Shiller PE. This is, for me, a good indication that the markets are still overvalued. Here we have it, Egon. There is a mean, the lower range and the upper range. And as we see it here clearly, the stock valuation is still in the red area. So we are here for now an extended period of time. In fact, more or less since the year 2000. It seems to me that the new paradigm that they once told us would be now is still here. And people still believe in this ever increasing stock market, right? But with the circumstances around us, I would be very careful to trust the Powell Greenspan put.
It was interesting with this chart, Jan, is also obviously the overvaluation was very strong in 2000, and then we had a big dip 2009, and now it's tried to test that again, that strong valuation, but that failed. So the trend is now down. That test, what we saw 2021, I think it was, peak that's showing there to the right peak there. Yeah, so that was a failed test, didn't reach the highs, and now we're in a downtrend, and this is going to go to the lower areas here, of course, well below the yellow field there. I think the trend is down. This is a massive overvaluation.
If we measure the stocks against the GDP, we are also still in highly overvalued territory. Look at this, it dates back until 1970 or so, and 176%, and assume the GDP, which I would expect once is shrinking. Wow, this has to come down.
Yes, I mean, this is Warren Buffett's favorite indicator, and we are 175% above GDP here, and what is interesting, of course, really the norm is the lower end of that dark blue field there, so that we saw in the 70s and the early 80s. So that's really where it will go back, at least, which is to the 50 level or below. I would guess that it would go below that also. We would shoot below the 50, probably down to below even the 30% level of GDP. That's the way the world is heading, and that's what happens when the bubble bursts, which we will see in the next few years.
Why the stock market is still so elevated were those hopes in soon rate cuts by the Federal Reserve. Okay, they are playing with the news, but lately they were a bit cautious. It might take longer because the inflation is picking up again. So they simply play the market to keep the stock markets up.
Inflation has come down temporarily. It's much higher than they're showing, of course, always is. They always cheat with the figures and adjust them. But this dip that we've seen in inflation now is not going to last. Inflation rates are on the way up. Commodity prices are going to go up dramatically. And we will see much higher inflation again, which the world, of course, cannot cope with. And that will create massive problems, not just for US, but around the world also, and of course for developing countries. This is going to hit the world at a time when they can't afford higher rates and higher inflation, but it will happen anyway because of market circumstances, in my view.
That is now already against the higher stock valuations, but they don't care. It worked nevertheless, and this is the tightening of the Fed balance sheet, and this is still continuing, although it looks like that will turn. Here's the graphic, Egon, and if we go to 1 year, we see already that it might turn. Who knows? But this is something that under normal circumstances is not positive for stock markets. Do you think that this is on the way up again?
Of course it is. The US is making massive deficits. We've gone from a 1 trillion Fed balance sheet in 2006, 7, 8, and then from 9 it started going up. So think about it, 1 trillion, and we've been up to almost 9, and now we're down a bit under 8. The financing requirements of the US government and the deficits will go up faster every year now. And I mean, we saw a 1 trillion deficit last year, and I think it'll be much higher this year, probably a couple of trillion at least, maybe more. And then you have the interest also on the debt, which is going up exponentially. And of course, the Fed has to refinance a major part of their balance sheet, about 8 trillion in the short to medium term, and that they can't afford either. So there'll be massive issuance of debt by the Fed. And remember, there is no buyer of this debt. And that's the critical point here. Before, they froze Russian assets, and which was the most stupid thing they could ever have done. Then it was possible to sell their debt abroad to other countries, other central banks, etc. Not anymore. Now, nobody wants to touch US debt because security can be confiscated by the government issuing it, namely the United States. So the only buyer now of US debt is the US itself, i.e. the US government, the Fed. And therefore, since there's no demand, the interest rate goes, they have to pay up. And so they issue the debt themselves, and they will buy the debt themselves. I mean, that's a banana republic if you ever seen one, Jan. And that's a recipe for disaster. And that's what we're going to see in the next few years, sadly.
So the interest will go up, but on the other hand, the people or the companies and the consumers, they will cry for lower interest rates, and the Fed still has some room left. Let's have a look at the sales of existing homes and then the foreclosures. Here, the sales of existing homes, they have a multi-year low, so the market is freezing. And if we look at the foreclosures, they are still low, but picking up. And if we go, that goes back to 2005. If this once turned, then it goes to one direction for a number of years. So I would expect the foreclosures to really increase here. And this, what we just said, puts pressure on the Fed to lower the interest rates.
So they need to lower rates. And as you said here, there will be defaults in the mortgage market, both domestic mortgages and commercial mortgages, the office buildings, etc. That's a massive disaster now in the US. And there are going to be major losses, major bank losses here. So we will have another bank crisis coming very soon. And so there's a pressure to lower the rates at the same time, as I said, because of the fact that inflation will continue high. And the US government, they will have problem raising money, and that will put upward pressure on rates. It's a very difficult situation, and it can only end in major problems for the United States economy, both government itself and the financial world, banking world, etc.